Today, we are moving behind the standard backward looking mutual fund metrics to decode the true construct of performance in a mutual fund portfolio. Shyam is here today to debunk traditional ideas on viewing mutual fund performance and tell us what truly matters. Let's dive right in. Okay. Hi, Shyam.
Hi.
Shyam, once again, today the topic is on mutual funds. There's a lot to discuss. Essentially, when you speak to investors, you do realize that although they've been investing for a long time, probably the approach needs a relook. You often say that performance, people look at past performance and invest, and that shouldn't be something which they should be doing. I do understand when you say look at 1, 3, 5 year returns or past SIP returns, it can be misleading. But there is also more refined ways of looking at returns, like rolling returns for consistency. People look at standard deviation, Sharpe ratios, and all that. And a lot of people make decisions based on that. In your view, is even this kind of a system flawed?
No, no. We also look at these ratios. There are multiple ratios we look at. We deconstruct a portfolio
Mm,
to the stock level,
mm,
apply ratio analysis
mm,
to the stocks to the extent of the weightage
mm,
they are in a fund.
mm,
So these are good. I
mm,
mean, I'm not saying that these aren't good. But my fundamental problem
mm,
is that recency bias plays out very heavily
mm,
when you look at past performance.
mm,
So you look at how people buy even something as simple as silver and gold
mm,
in a year like this.
mm,
Maximum money gets added when the past performance looks the best. Like when it's in the pink of performance,
mm,
that's when too much of money flows into a product.
mm,
In my view, this is something that you need to avoid.
mm,
That's your first line of defense
mm,
in your portfolio building
mm.
in mutual fund.
Okay.
So most people fall for this.
Mm.
That is my only problem.
Okay.
Now, ratios will look good for a fund
Mm,
most of the time. In a good fund, the ratios will always be healthy,
mm,
particularly the financial metrics
mm,
of the shares in the fund
mm,
will look good most of the time.
mm.
It's only what value you pay for that.
Okay.
So, even when it's not a good time to invest, the ratios will look very attractive to you
Mm,
because they are investment ratios
okay.
based on the business performance of the company.
Mm,
But valuation is a separate subject, right?
mm. Okay. Okay. Okay, so if you look at how I built a portfolio, I wasn't looking at the fund portfolio so much. Yes, I did give some weightage to it, but I went more by these ratios and these rolling returns, kind of the consistency levels in the return generation and things like that. So my portfolio return experience has been pretty decent. It has been in the early teens to the mid teens, and when market fell in March, for example, I dropped by about 1.5 percentage points or 2 percentage points, and it is back. So I haven't followed an entirely portfolio based approach, and I'm pretty happy with my investing. Do you think I can continue like this?
Of course, you can.
Mm,
There's no one way to
mm,
success.
mm,
There's no one way to success.
mm,
What I have understood in my experience
mm,
in fund research
mm,
and investing based
mm,
on fund research is
mm,
that you will do well if you're a disciplined investor.
mm,
There's no doubt about it.
mm,
Most disciplined investors do well. What you forgot to mention
mm,
about your personal investing is
mm.
you have stayed invested in a product for 5 years.
True, my average portfolio age will be about 10 to 15 years. Yeah, yeah.
That is something that's not easy.
Yeah. Mm,
The
mm,
noise is just too much around people.
yeah.
And those who do it by themselves
Mm,
are also, shown numerous investment options
mm,
by the platform where they are investing.
mm,
So
mm,
it's natural that they want to explore, they want to try something else.
mm,
There's something new that they
mm,
think they can put some exposure.
mm,
So they always take out money.
mm,
So money gets churned much more
mm,
um, for most people.
mm. Okay.
So for such people, then you need a approach quite different from yours
Okay.
because they are going to always take more decisions and some of these decisions can go wrong.
Okay. Mm.
You have taken a few decisions and let them run for a very long period of time.
True. Mm,
Usually in that scenario, you do very well.
mm,
Like you take one of the best performing products of uh, the Indian mutual fund
mm,
industry
mm,
historically.
mm,
It's HDFC FlexiCap.
mm,
If you take a 25-year or a longer view, I think it's been around for such a duration and the different names. Now it's called HDFC FlexiCap. You will find that it's done exceptionally well. But the same product in a particular market context did not look investable to me. Then it turned. Then it looked investable after some time when somebody else started managing it. Today, it continues to draw a lot of investment. It has been drawing investment support of people for 25 years. But if somebody entered during the time when I felt it is not investable, 3 years later, I would have seen that they left on their own. They invested on their own based on past performance and they left on their own. My point is this should not happen to any investor, even in the best of funds. This is a product which I actually say has done a stellar performance when you look at a multi-decadal time horizon. But even there, this happens. And it will happen in multiple products. Because when people enter a product at the wrong time, 2-3 years later, they feel, it's underwhelming. They are not willing to give the 10 years which you are given. Though while investing, they think I'm going to invest for 10 years. But the disappointment sets in very easily in people's minds. And sometimes some styles won't work. Like in this case, this was a phase when the value style didn't work. But it again came back. So it's not just the past performance. What is the style? What is the fund management approach? Will it work for the next few years? If the style or the fund management approach won't work for 3-4 years, you're better off investing elsewhere than in the place where the past performance looks exceptional. You can always go back to that. That is my view.
Okay. So I do understand you said 3-4 years and all that. But my doubt here is if you keep looking at portfolios, how fund managers churn, suddenly when a war comes, then the outlook changes and all that. Now, does this mean that essentially following a forward-looking approach is actually going to result in a higher churn of the portfolio for an investor? For example, why I'm telling you this is because there are lots of investors who are today coming and telling us that it's okay if small cap funds don't give good returns in the short term. It's okay if it's volatile. I'm looking at 10-year returns of a small cap fund and I'm willing to stay put for 10 years. So why should I not invest in a small cap?
So there comes a time in a theme's cycle where its past performance is compelling. In 2000, past performance is compelling in IT. And companies have done very well even after that. In the next decade, between 2000 and 2010, or 15 years till 2014, the technology companies did very well in their business. But the returns did not match. For 10-12 years, people didn't make any money. If you had stayed 10 years in tech funds from 2000, you would have not made any money. But the companies had grown multifold from 2000 to 2010. What investors need to understand is when you pay too much, when you overpay in relation to the growth potential of companies, then your primary loss is not money, it is time and opportunity. Because you could have done something else and then come back to the same thing. So when you are stuck in a place for a long time and nothing happens to you, and most of the things you expected to work for you don't work. At that point, you feel defeated. The primary goal of an investor should be to avoid that situation in his investing.
So you mean that at every point in time, you should be looking at opportunities which give you the best compounding rather than, sitting it out even through...
Why would every investor want to show his pain-bearing capacity and wear it on his sleeve? I ask even fund managers who are my friends, why are we trying to take so much pain to prove that we are good at what we do? There's no need, actually. When you have an easier path on the other side, where you don't have to, bear this pain, I'd rather you take that. It's like a bypass road. So you have to bypass these so-called super popular hot themes in every bull market and go in another path, which is less crowded, where maybe it's boring, but you're going to have a better investment experience.
So even if there is churn and if there is a tax implication, it doesn't matter because you're going to do better in your returns.
That's coming to tax. Coming to tax. In my experience, mostly we have sold mutual funds only after 1 year. 90, I would say 95% of the time. The only time we were forced to sell a mutual fund before what is technically long term in taxation was when we sold silver and gold during the recent boom. So it's not a habitual thing. We won't do it. Another situation where you have to sell short term is suppose there's a governance failure after you invest in the fund. Then you have to invest. Hypothetically, that situation, if it arises, you have to act. I'm just flagging it. Otherwise, most of the selling is long term. Which means your tax is 12.5% plus surcharge. So it's fine. It's not a very high thing. Moreover, if you calculate how much of your portfolio you're churning, say a portfolio is 100. In my view, per annum, the churn won't be more than 30%. That is a high number. Unless you have one peak bull market where you go to 60% cash or something like that, or you go to arbitrage. That is rare once in 7-8 years. Let's not take that as a standard now. In a normal year, I believe your peak churn will be maximum 30%. What you sell itself. Assume the entire 30% is profit also, your tax will be only 4.5% on your overall portfolio, which I think is reasonable.
Okay. The other side to this is also the costs. For example, can a direct investor actually replicate the whole thing of looking at a portfolio, churning at the right time or holding on at the right time by himself or herself? Or do you think that this kind of a strategy, which requires little more looking at portfolios very closely, works best with an RIA or a distributor who can develop as an advisor?
Before we go into the merits of what a direct investor can do, a DIY can do, let me just clarify a very fundamental thing. When you need to act, you must act. You should not miss out that window of time when you can act and either maximize your profits or protect your profits or avoid losses. All these things have to happen. So, a DIY investor must do it. To your question of whether he can do it, I will never generalize saying that somebody cannot do it. Those who work hard and think hard can do it. But it requires for giving that kind of time and effort so that you get to understand what you need to do clearly yourself without help. Now, alternately, if people are in busy careers and personal lives are also hectic, then when they outsource this decision making to somebody else, in this case, as you suggested, an advisor, RIA, he has to be filling in for what the investor cannot do. And he has to be very precise. I think that precision adds a lot of value to outcomes. It definitely improves returns. I believe that investment should be very precise. It should be very precise and very targeted at all times. You can't do vague things and hope that you'll be super successful. More so, all of us want to not just beat the index, but we want alpha, genuine alpha. Everyone wants to make genuine returns over long period, not just beat an index. If index does -4 and you've done -1, you're not going to be happy, right? You want to make a +12 or whatever, 10 or 14 or whatever. For that, you need to have a differentiated approach. You cannot do run-of-the-mill stuff. That's my sense. Otherwise, you should go for indexing. You will get that 8 to 10% or 11%, whatever it's giving. For that extra 3-4%, you need to be differentiated. You need to be precise. You must sell when it is a time to sell. And you must get into newer products. You must bring freshness into the portfolio when it is absolutely necessary. You must not disturb your portfolio when it is okay to run it for long periods of time. So it's a judicious way of investing, which for you becomes a way of life.
Okay. We did discuss in our previous decode about mutual fund investing becoming more and more sophisticated and a lot of layers getting added in terms of looking at the AMC, the style of the fund manager, and so on. Today, we have PMS products which are with underlying as mutual funds very popular.
Correct,
and
correct.
SEBI has also recently put out a discussion paper allowing a lower ticket size for these products. Since on the one hand, it's becoming very sophisticated, do you think, using an advisor or a distributor is one route? Do you think this MF-based PMS products will be value adding to an investor? Though you get another layer again here in terms of churn, taxation, costs and so on.
So when I ran an RIA, we did the quality of ideation which is needed for this. Our research and advice was exactly at that level which people want from this MF-PMS. But the problem is the decision maker is the investor.
Okay.
Now, I am telling him buy this investment with whatever information he needs to have. But he is layering it with the secondary market judgments, social judgments, peer judgments, everything. Whatever he hears outside, he'll come and layer and he won't do it. So what we used to find is a lot of people missed out on good investments, best investments at different points in time.
Okay.
This MF-PMS completely eliminates that. It gives the manager full discretion. Decision making is the manager. So I would not, if I am running an MF-PMS, I would be very happy doing it because I don't have to, convince the investor each time.
True.
Because the time and effort is very high for them. Sometimes investor doesn't agree means he completely misses out on the opportunity. Whereas here,
no, the thing here is people seem to be open to the idea of paying fee and taking the tax burden for the churn when it comes as a PMS based product. In expectation of a higher return, whereas the investor has not been willing or slightly unwilling to do it when offered as a general service by a distributor.
I think it's because we have kind of demonized one section of the fraternity. We should be more objective in this. That's what I feel. Investment mistakes happen at different levels. It happens at the investor level, it can happen at a distributor level, it can happen even at a manufacturer because you're putting a wrong product at the wrong time in the market. A lot of people buy it because your reputation is very strong. That can also be an investment mistake. Now, how to avoid this should be the primary focus of the investor. I mean, you must almost be obsessed about it. When you are outsourcing this decision making completely to a portfolio manager in a MF-PMS, you are taking the pressure away from you and say, okay, he's going to do this. I'll just listen to him. I'll question him on what's needed and I'll allow him to take all the decisions. I like this idea hugely because I knew what this could have created because of my entire journey in mutual funds over these 17 years. It's something which I truly believe in. And with respect to paying fees, you had mentioned, that's something very touchy and sensitive. In my assessment, in our system, in the iThought system, the cost differential between distribution and, let us say, the MF-PMS won't be high. It's whatever we're getting now, our MF-PMS cost will be similar. And it will not be very high. It will not match the regular PMS. But still, it will be very effective in delivery. Right? The cost differential is not very high, in my opinion. It's almost the same cost. The problem is you are comparing a transaction platform with a distributor who will probably give you valuable advice. That advice has to be objectively valued. And you should make your decisions on whether to work with a person or not based on that objective judgment. I feel people make a very emotional judgment in this area.
So you're saying sometimes they listen, sometimes they don't listen.
Yes, it's a fact. It's a fact. It's their money, right? I'm not saying this with any gripe or anger. It is their money. So the only person who can convince them to do what is in their interest is not the advisor. Eventually, it is only themselves.
True.
They listen only to themselves. We all only place everything before people. They pick what they want. That's what is happening.
Okay. So the other point here is you spoke about demonizing. One thing which most of us generally without a second thought demonize is also NFOs. That I think has happened also because NFOs come out when themes are peaking and all that.
Yeah, correct.
But coming back to your style of looking at funds for investing. Now, if you say valuation, portfolio construction style and all that, you needn't really worry about the fact that an NFO doesn't have a past performance track record, isn't it? So even if you don't do
you're
it,
saying don't worry about
don't
it.
worry about.
You're flipping
so yeah, you don't have to worry, isn't it? Going by your philosophy. So if you think that it doesn't have to be in the NFO window, even 1 or 2 months down the line when the deployment happens gradually, you could take a look at the portfolio and
2 years later, I have 2 months later, I have no problem.
Exactly. I mean, even then, if you go by past performance, it doesn't have, isn't it?
No, it's not past performance. performance. So when you look at the product and you see inside the portfolio that it's got merit, you should invest. The fact that it is just 2 months old should not matter. That's my view.
Okay.
And when you look at a portfolio, suppose past performance is not there even after it has run for 3-4 years, but you see a great portfolio correctly aligned to the market context, then also you should invest. You can't shun an opportunity which is ready to do well.
Okay.
So that is my point. So you don't have to, be worried too much about that. Where there's a need to do something, just go ahead and do it.
So you're saying that if you find NFOs and undervalued themes coming up, below the radar themes coming up, they are good ones to consider actually.
In 10 years, you'll have a few, handful. Don't miss them.
Shyam, usually performance is measured against benchmarks. And generally the thesis in mutual fund investing is if your fund is not beating the benchmark for whatever time period everyone is comfortable with, that is still not clear. If your fund is not beating the benchmark, you better go for a passive fund.
Correct.
Because you will at least be saving on cost. Now, going by your investing style, would you actually choose a fund which hasn't been beating the benchmark for quite some time if the fund shows promise otherwise?
Perfectly, yes. I would definitely do that. So many times I bought PSU funds and they're completely out of favor. We have bought gold and silver and the returns are pathetic. Same applies to multiple products. I think when the returns look very bad, if the portfolio is very strong, I would back it. I won't worry about returns. Because the forward earnings of the portfolio may have improved dramatically, while the portfolio never gave any returns. That means it's going to come back in the future.
Okay. But it is totally twists the whole thesis. Generally, investors believe on its head, isn't it? So
yeah, but you have to be contrarian. Otherwise, how will you win? If everybody is going to buy the same funds like I am seeing today, they're buying two categories, left and right. They're not buying the headline companies because they think that some growth is not to their liking. That opens up an opportunity for those who will do it differently, right? So if you want to be in the exception camp, go ahead. Why not?
Okay. So I get the feeling that this forward-looking theory of investing is a kind of a high conviction, high risk, high return strategy. So do you actually think it is so and it is suitable only for a certain set of investors?
No. It is suitable for anybody. So we have worked with 10,000 investors. I have never had difficulty in convincing somebody on the merits of being a contrarian investor. Indians are very much capable of acknowledging and using this information correctly. There's another angle to this. I don't think high conviction means high risk. Like wherever I have done high conviction investing in mutual funds, my risks have been low and the returns have been high later. Taking high risk with high conviction cuts both ways. I want to restrict my risk and increase my conviction. And bet on the asset class rather than on just one part of the asset class.
Okay.
You have to have a holistic portfolio which has got multiple assets. And that mix should be correct. When you do that, automatically the risk goes down. It's no more high risk.
Okay.
I think if you do that correctly, you'll actually get high returns. Not go and take peak risk. Like, people do only small cap in their mutual fund. They do only mid cap in their mutual fund. Some people do only small and mid. That I don't endorse. I'm saying that you should also keep your ambition in check. You should not allow it to go wild such that you start making investment mistakes and judgments. That's very important.
Contrarian investing is all about spotting future opportunities when no one does. And this is truly one of the ways to generate superior performance even in a mutual fund portfolio, is the key takeaway from this conversation. Thank you very much for watching. See you in the next episode of Decode.